Hi, this is Wayne Zell, and welcome to Blueprint for Wealth, your video cast featuring special content and special guests designed to help you realize your personal dreams of wealth and freedom. Blueprint for Wealth is brought to you by Zell Law, a tax, estate planning, and business planning law firm located in Reston, Virginia, serving clients all across the United States. If you'd like to know more about us, visit us on the web at zelllaw.com. Today's educational moment is featuring the 10 rules of stock options. And let's get started. The 10 things you need to know about your stock options are the following items. Number one, set goals. What do you want to do with the proceeds once you exercise your stock options and sell the stock and get money in your pocket? It's a financial planning exercise that you have to go to. Are you going to use the proceeds for your base savings, for your rainy day fund, for planning for the near future? Are you going to use them for your legal support obligations? Or are you going to do something special like add on to your home or buy a new one, build a vacation home, or even take a vacation? Do the planning up front, set your goals, and then decide how much of your stock options you should exercise and when. It helps you focus on your specific use of the proceeds from the stock in regards to your other financial planning obligations, income, and savings. Number two, develop a plan. How do you handle your stock options over time? Well, this involves understanding the tax issues relating to stock options, which we'll cover in a second. And also, if you exercise today, and you lock in your stock appreciation today, have you lost out on gains in the future by exercising now? Developing a good plan helps you focus on your specific use of the stock in relation to your other income and savings, just as I mentioned a second ago. Exercise and sell just enough to meet your goals. There are really two approaches that you could adopt. One is stagger the exercises of the stock options and sales over a period of years to spread out the income tax obligation, or hold the options until the last possible moment when you must exercise them in order to best maximize your gains. Number three, you really need to understand how to value your stock options. You need to account for the exercise price, the strike price that you have to pay when you exercise the option. It might be a very low price, or it might be very close to what the fair market value of the stock is today. So you have to account for the exercise price, and you have to account for the taxes that you're going to pay. Here's an example. Let's say you own 1,000 options to purchase 1,000 shares that are worth $100 a share today in the public market. That means that you would have something of value equal to about $100,000, right? But you have an exercise price to pay for the stock, and if the exercise price is $50 a share, then you're really only entitled to get the excess, $100,000 minus $50,000 or $50,000. And you've got to pay taxes at a 40% or more rate on the exercise and sale of the stock option. Note that if you have a non-qualified stock option, you automatically are going to have tax withholding of at least 25% taken out of the proceeds. Number four, you could wait to exercise. If the company value is increasing, hold on to the option until you can afford to exercise. Because if you exercise now, remember, you may have to pay the exercise price and the income taxes to the federal government, depending on the kind of option you have. If you have an incentive stock option, which we'll talk about in a few minutes, the alternative minimum tax may kick in on the exercise of your option. If you have a non-qualified stock option, then you're going to be subject to regular income tax on the exercise of your option for the difference between the fair market value on the date of exercise and your exercise price. Typically, most stock option plans give you 10 years from the date of grant to exercise your options. But if you exercise the option and hold the shares and hold for at least a year, you can get long-term capital gains treatment on the resale of the stock. That's a 20% difference in income tax rates between long-term capital gains rates and ordinary income rates, at least under current law. Number 5, when you need to ignore rule number 4. Don't wait too long if it doesn't meet your goals. Also, if all of your net worth is tied up in your stock options, you may need to diversify your holdings to reduce your risk. If, say, 25% or more of your net worth is concentrated in your stock options, and you have the ability to exercise and sell them, then you may want to do so, again, to diversify your portfolio, diversify your holdings, reduce your risk. But you can't just do it at any time if you're involved in a public company, because you may be subject to restrictions on trading that apply to insider trading. If you have inside information relating to the company, you may be restricted from selling the shares while you possess that inside information and the public does not. Number 6, what happens if you leave the company? Well, make sure you read your stock option plan and your award agreement carefully. Know your rights if you're fired with or without cause, or you quit, you voluntarily resign from employment. Usually you'll have between 90 and maybe as long as 180 days to exercise your option. If there's a death of the option holder, they may have as long as 12 months to exercise the option. And disability has its own rules under your plan, under the award agreement. What if you go to work for a competitor? Well, if you go to work for a competitor, many stock option plans may say that you automatically lose the right to exercise your option. They disappear with no benefit to you whatsoever. The bottom line is, make sure your family is aware that you have these stock options, where the agreement is, and where the plan is, so that they can take action if something unfortunate happens to you. Number 6, learn about the alternative minimum tax if you own an incentive stock option. An incentive stock option is a special kind of option that's issued by publicly traded and some privately held companies that get preferable tax treatment. When you exercise an incentive stock option, you do not have to pay regular income tax on the exercise, unlike a non-qualified stock option where you do have to pay regular income tax on the exercise equal to the difference between the fair market value on the date of exercise and the strike price or the exercise price. In an ISO, you may have alternative minimum taxable income. It's treated as a tax preference item on the exercise of the ISO. Even though it's not subject to regular income tax, it's a trap for the unwary. And if you exercise your ISO, you may owe alternative minimum tax if it kicks you into that realm. The spread between the fair market value and the exercise price is known as an AMT preference item, and it could subject you to tax at rates up to 28%, meaning that a paper gain could be taxed, so be careful. Number 8, focus on vesting rules and dividends. If the options allow you to immediately exercise them, even though you're not vested, meaning that you have to work for some period of time or you have to hit some performance targets to earn the option, you could exercise them today and lock in the low exercise price, particularly if the company is increasing in value. And then you would be required, in order to lock in that lower basis for the shares that you were exercising, you would have to file an 83B election. That's referring to Code Section 83B of the Internal Revenue Code. It has to be filed within 30 days of receiving the stock option grant. If it's not a valid election, and there's really no way out from making a late election for a Section 83B election. But it locks in your tax basis and your holding period so that when you vest later on, you're not subject to tax again. And when you sell the shares, you can get long-term capital gains rates if you've held the shares for at least a year and you're vested. You can exercise and hold the shares if the company pays dividends. Again, that's another reason to exercise early, because you may be entitled to receive dividends even though you're not vested in the shares. Take a look at your plan and your option agreement. And last, get good advice from your advisors. Find out how often the advisor deals with stock options before you entrust this valuable asset to them to help you make your financial planning and tax planning decisions. And get references from clients. If you want to know more about stock options, visit us on the web at zelllaw.com or give us a call at 571-203-9355, 571-203-ZELL. We'll be happy to schedule an appointment with you to talk to you about your specific issues. I'm Wayne Zell, and thank you for joining us for Blueprint for Wealth. Stay tuned for our special guest.